Hello, I'm Pat O'Hare, Chief Market Analyst for Briefing.com. Today is Wednesday, March 18th. Overbought or not, the buyers kept coming Tuesday and extended the market's rally effort. Since its bottom on March 6th, the S&P 500 is now up 16.7%. A healthy degree of skepticism about the sustainability of the rally is perhaps one of the market's biggest sources of support at the moment, as its resilience continues to test the nerve of short sellers. The advance has brought the S&P 500 within striking distance of its 50-day simple moving average, now around 806, which has acted as a successful resistance point in prior recovery tries since last August. Accordingly, one needs to be careful about chasing the rally at this juncture if their investment time horizon isn't measured in years. There's a good bit of news this morning. IBM is allegedly interested in acquiring Sun Microsystems. Darden Restaurants topped quarterly earnings estimates and issued FY09 earnings guidance above the current median forecast. And China has rejected Coca-Cola's bid to acquire He-Wan Juice, saying it would be anti-competitive for domestic companies. China's rejection of Coke's bid comes at the same time Mexico has indicated it will impose tariffs that are as much as 45% on some U.S. products in response to the U.S. decision to end a pilot program that enabled Mexican trucks to haul goods in and out of the U.S. These two issues may be thought of more as white noise at this time, given all of the other issues we are contending with, yet they are unsettling developments nonetheless, since they have a protectionist flavor to them. If anything, they should remind listeners how the subprime mortgage crisis has evolved from a U.S. housing problem to a global economic problem that has heightened the risk of political discord retarding recovery efforts. On that note, we will hear the latest perspective on dealing with the crisis from the FOMC today. The intrigue surrounding the 2:15 Eastern Time policy announcement has nothing to do with interest rates. They will be left alone. What participants will be listening for are the unconventional policy steps the Fed plans to take or doesn't at this time. For example, stepping up purchases of mortgage-backed securities, increasing the TALF facility, and or buying longer-dated treasuries. There will also be interest in the level of dissension at the meeting. In January, Richmond Fed President Lacker, who wanted the Fed to start purchasing treasury securities, was the only dissenting voice. Separately, February CPI came in a bit higher than expected, with a 0.4% increase for the total index and a 0.2% increase for core CPI, which excludes food and energy. The February data boosted the year-over-year increase in total CPI to 0.2% from 0.0% in the prior month, and the increase in core CPI to 1.8% from 1.7%. As expected, the energy index played a key role in pushing up total CPI. It increased 3.3% in February, led by an 8.3% jump in the gasoline index. The latter index accounted for about two-thirds of the all-items increase. The food index, on the other hand, declined 0.1% and helped restrain the overall increase. Housing was unchanged, although the indexes for rent and owner's equivalent rent were each up 0.1% after 0.3% increases in January. The apparel index rose 1.3%, transportation was up 1.9%, medical care increased 0.3%, recreation was up 0.4%, and education and communication increased 0.2%. The higher-than-expected consumer inflation readings shouldn't be too bothersome, given that 7 consecutive monthly declines in the crude goods and intermediate goods indexes in the producer price index suggest prices of finished goods for producers should be held in check, thereby limiting the potential pass-through effect to consumers. Also, generally weak levels of demand are curtailing pricing power at the consumer level. I'm Pat O'Hare for Briefing.com. Thanks for listening.